program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call. It's bonds versus equities. I'm Mark Todd from FIIG Securities, and tonight, if you have any questions on the share or bond market, please pick up the phone and call us on 1300 30 34 35, and the email is yourmoney@skynews.com.au. And joining me on the panel tonight is Chris Joy from the AFR columnist and a Yellow Brick Road director, and Simon Eagleton from Mercer. And Simon, you're in charge of all of Asia, all of Australia and New Zealand.
That's right, on the investment side, Mark.
On the investment side, so that's probably a pretty busy business at the moment.
Keeps us very busy.
We love it when you're active. Let's talk about the big number. It's non-farm payrolls. That's a big number tonight. It's I was looking at some of the PIMCO commentary, and they were saying this is the one. This is the one that gives you the guidance. 3 options. It's at 168, and it's going to muddle along, and it's all about the tapering. 200 plus. Whoops. Okay. That's a whole different ball game. We've got, we're going to try and unwind this taper quicker, and if it's in the 100s, it's all of a sudden game on. We're going to have to work out another policy. What's your thoughts on the non-farm in terms of its importance?
Yeah, clearly a very important number. Good signal on employment conditions. I think one thing that's fascinating is, first of all, it's volatile. The other thing is that we've had, for years, of course, any positive news has been leapt on by risky assets, and they've gone up. Just recently, though, of course, any sort of signal of potentially positive news, like a strong non-farm payroll number, could go the other way. Risky assets could go the other way, as markets worry about early exiting of QE. Fascinating.
What about you, Chris? What do you think?
Yeah, I completely agree with Simon. I think that we're in this bizarre situation where a positive signal about the performance of the US economy and its recovery is going to potentially be very bad news for risk asset classes. And what we mean by that is equities. And it'll also be potentially bad news for fixed rate bonds. We've talked about this many times on the show.
You always say this. Yeah. Every time I say how the equities, you say the fixed rate bonds are really in trouble.
This is the point. So what tapering we're really talking about is that the US Federal Reserve's been pumping $85 billion a month into the bond market, and basically governments are bidding up the prices of assets. Now, the Bank of Japan, I think today, announced that it's going to lift its investment in equities to 12% of its balance sheet. So governments and countries around the world are trying to lift these prices artificially high to reduce their implied cost. And when they step back from doing that, it's quite reasonable to expect that prices will adjust. So the long-term increase in interest rates as they normalise back to more standard levels will likely bring about a reduction in fixed rate bond prices, and that's I think what the market's nervous about.
But what's your timing on this? Because I just think it's low for longer. The low rate environment, I understand exactly what Bernanke's saying in terms of he wants to see a really strong growth. He wants to see it over a period of time. I just can't see, when the Japanese have just started, the Europeans don't know what to do. They've just done one deal, so they're trying to work out how to get it going, how to get their economy. I just can't see rates going up in the medium term, just because of the driver that it's trying to offer. I mean, what do you think in the medium term?
It's interesting. In the medium term, I think you're right. We're going to have to see some pretty strong, solid economic numbers before any kind of exiting of QE, and that's my view.
There's no evidence of that on the horizon.
Yeah, it's interesting. The Japan story, I think, is absolutely a sensible thing to do, to try and get your currency down and try and surge, get a bit of inflation going. But I think with Japan, the economy is not going to go anywhere without real structural reform, and of course that's very tough in Japan with their demographic profile.
How do you make that? Yeah, Chris? How do you make the structural reform? What do you make people younger? I mean, how do you wind the clock back? You can't do this.
Japan has 2 problems. The first is that its population will shrink by about a quarter, literally shrink over the next 40 years. So you've got a failure of underlying demand. But the second point
is, let's do the numbers. What's a quarter? There are
25%.
No. How many people?
So we're talking about, actually, Simon probably knows. I'm not exactly.
I think it's 100 million people. So it's, you're talking 25 million people. That says, okay, I'm now 96 and I'm moving on because everyone lived so much longer. So
and there's no immigration, so they've got a very
by choice.
By choice, there's a very homogenous population. So that's a real problem for long-term growth. But coming back to your point on QE and timing, I think it's a really good point. The risk for portfolios and the risk for investors is that markets get ahead of themselves. And I think what's really fascinating in the last 2 weeks, it's almost like we've fast-forwarded in time, and the markets have suddenly turned their collective minds to the prospect of higher long-term interest rates and tapering in QE. And so I think the risk is that the actual increase, the actual recovery in the economy is preceded by big changes in financial markets. So financial markets lead the real economic cycle.
Which is consistent with the GFC. Some people started to model the cost of the mortgages, you rate set mortgages, and went, whoops, people can't afford this, and that meant the housing market completely crashed. The idea that there's going to be an orderly unwind, and I gave a presentation this week to a room of people, and they all to a person believed there was going to be an orderly unwind. They believed that could happen, and I was thinking, these people can't be in the financial markets. I mean, can you see an orderly unwind?
I can actually, Mark, so I'm going to disagree.
We've got a bit of tension. Let's go.
That's good. I can, because I think any kind of unwind in reality will be very gradual and it will be signalled well in advance. I think the kind of things we're seeing in the recent months, sort of signalling of tapering.
But that's discounting the greed. Look at Paulson and all those funds. That they will they will borrow as much money and they will smash that treasury market in the long end as hard as they can. They will take on Bernanke and the Fed. I mean, that's what their job is. They will try and make money out of this situation. I mean, what do you think about the orderly unwind?
I think that we're likely to see some heightened volatility as markets wrap their minds around what unwinding really means. We've had the local equity market fall by about 10% in the last few weeks.
Yeah.
We've had a 10% decline in the currency. We've had some pretty big moves in commodity prices. So I think it's my own view is it's unlikely we're going to see a smooth transition. And I guess one question is how you define orderly. And my hope is that markets, we're coming off this stimulus drug, which is governments again interfering with privately traded assets and trying to change the prices of those assets so that we're lowering their implied cost. And when governments eventually step back from that, or markets start anticipating that they'll step back, we could see some sudden shifts. But I think investors have got to look over the horizon. They've got to realise they're dealing with 20, 30-year planning windows, and they've got to live with that noise.
I love that, because I did this. My speech this week was rise above the noise, because you are so busy, you are swamped with all this information, and I respect the AFR columnists, but you are swamped with a lot of data, a lot of information. You're trying to get some rational thought about it, and we've spoken on the show. You apply the Rumsfeld portfolio. You don't know what you don't know, so let's build a business or a portfolio around what I just don't know and move on. What do you think about the idea that if we see really strong employment growth, it naturally leads to inflation in the United States? Because one of the reasons we've been talking about these low rates is inflation is so benign, and there hasn't been a wage increase for anyone in the United States from about 2008, and so everyone works for longer for less. And now if you start to see these massive employments of 200,000, do you not think that they'll then turn around and say it's now our time? It's now our time to get a wage increase? Do you not see this? Do you believe there'll be wages pressure? What are you thinking?
I think any kind of, market participants have been talking about, inflation breakout in the sort of latter part of this decade. I think the authorities will be very cautious. For example, we've seen the QE not being, expansionary in terms of broad money supply at all. The banks haven't actually lent it.
No, that's right.
And I think any kind of longer term exit of QE, I think the authorities will be, hawkish on trying to neutralise expansion in the money supply. But then, of course,
what's the hawkish tool, Chris, as the economist in the room? What do you think? What are we doing?
Well, I think I hope Simon's right again. I hope that central banks remain independent and they try and anchor inflation. But even here in Australia today, we've had a 10% decline in the currency. Almost mechanically, we're going to get higher imported inflation. So that's sort of looming probably 2, 3, 4, 5 quarters away. But wait 1 second. So in the SMH I read, I think today, already people are saying to the RBA, I want you to look through that imported inflation, or the imported inflation, and look look through the temporary spike in the CPI and keep rates low. Now, when the currency appreciated, we had lots of rate cuts on the back of this low inflation that we've had in Australia, which was principally driven by imported deflation. So there's not a symmetrical response there, if that's what ultimately comes to pass. But I hope someone's right.
Talk for the viewers. Explain what you mean by imported inflation. That's what I want to try to stop.
So in Australia, our inflation numbers, which are a proxy for the cost of living, 1/3 of those items are priced in international markets, so to speak. So they compete in international markets. And if the currency appreciates, basically it means, generally speaking, that the price of those goods and services become cheaper, and so we get price falls or lower price growth. And the key driver of the low inflation that we've had in this country since about 2008 has really been those internationally priced products.
So can you give me an example of an internationally priced product?
Electrics, anything that we import, basically. So anything that we can use our currency to buy overseas is one good example. But also industries that compete against overseas markets. So tourism is another example. But 2/3 of the inflation basket is actually domestically produced items that are priced in the domestic economy. And domestic inflation has been running at 4%. The RBA's target's 2 to 3%. So we've basically had zero international imported inflation on average over the last few years, and we've had high domestic inflation. The issue is with the decline in the currency, the imported inflation is going to rise significantly. We're going to get higher inflation numbers. Does the RBA look through it, or does it start to normalise rates?
We can talk about the linker bonds later on in the show. It's time for us to take a short break, but please give us a call on 1300 30 34 35 if you have any questions on the bond or equity markets, or if you prefer to email yourmoney@skynews.com.au, and we'll be right back. Welcome back to Your Money, Your Call. If you have any questions you'd like answered, please pick up the phone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. And we have got an email. It's an email from Peter. So we'll go to the first of the night. Mark, can you please explain the difference between bank yield and a yield curve? Thanks very much, Peter. We do hear a lot in the press about the yield on dividend yields and yields for bonds and yield to maturity. So, Mr. Bond expert, do you want to tell me what a bank yield and a yield curve is?
Well, the yield curve is simply what the financial markets think interest rates will be doing over the long term or any specific year that you nominate. So the yield curve will give you an estimate of what the average interest rate is between now and 3 years, 5 years, 10 years, 15 years or 20 years time. So for example, 3-year government bonds today are telling us that they think interest rates will be about 2.5% or 25 basis points lower than the current cash rate for the next 3 years. Bank yield, in contrast, is just the dividend income divided by the price of that particular asset. So they're two quite different concepts, and obviously shares or bank yields are a very risky asset class in comparison to those that we normally associate with interest rates like cash and
because
bonds.
You can actually deal on some of these cash instruments, so you can go out and lend for a term deposit for 5 years, and that's the yield you're going to get, that's the return you're going to get, whereas the dividend yield clearly can move around it. And I think part of the investment community, certainly for the self-managed super funds, have just assumed a lot of that dividend yield will stay consistent, particularly in the 4 majors and Telstra. Is that sort of a risky proposition, do you think, Simon?
Well, equities clearly
no, the
always
principle
risky.
around, I can see that I'm getting 28 cents on Telstra, I'll get it forever. It's fine, it's never going to change. Is that a risky premise? Because essentially when you buy Telstra at $5 and it's now at $4.65, you really don't want to take the hit on sell it, so you've got to hold it at $5 thinking you're going to get 28 cents. But is that a risky premise in terms of your investment thesis?
It's certainly risky in terms of stability. I mean, as Chris explained, you're talking about the cash dividends divided by the price. We know share prices move around all the time, 10% in the last couple of weeks. So your yield will, that percentage yield, your dividend yield, will move around all over the time. You wouldn't want to be relying on the stability of that number for income.
Capital structure, we'll be talking about that, yes.
And just one other point I think on that is that the dividends that companies pay when you're a shareholder, when you're an investor in equities, they rank last in the capital structure, and the company is under no obligation to pay you those dividends. So the key point to, I think, understand is that both the percentage yield, as Simon explained, can change, and it will change almost every day, but also the actual dollars you change, the dollars you receive receive are at the discretion of the company's board. Whereas when you invest in a bank deposit, those interest repayments are legal obligations of the bank and they must pay you them, and if they don't, they default.
And the other thing with the dividend yield, you're also, the regulator can step in and say, hang on a second, I don't want you to pay that because you need to go into a trading halt because you don't have the receipts. You're using our capital to pay our dividends. We're heading for a train wreck. So, and that's always quite hard to come to grips with. It is, and in fact, in recent history, we've seen examples of companies exactly like that in this incredibly strong demand for yield from the whole retirees and all of that. We've seen some infrastructure securities, listed property trusts, etc. Paying out yields, but their own capital
that are in excess of their underlying cash flows.
We have our first call for the night. We have David from Sydney. Hello, David. How can we help you?
Oh, hi there, team. Look, you just mentioned the concern about sort of maybe inflation starting to emerge, and I wondered two things. Firstly, what's the panel's overall view on when that might start to emerge? Are we talking 12 months, 18 months, 24 months, 3 or 4 years? And secondly, the reason I'm interested is because that will define what sort of duration of both bonds and of fixed rate bonds and of term deposits one might choose to take up. And I'm just curious to know sort of what each of the panel think about when we might start to see a rise in interest rates and so on.
Great question, David. Inflation, what's your thoughts in the medium term?
Yeah, we can't see inflation being a problem in the near term. The kind of time horizons that David was talking about, I think it's very unlikely. And in fact, we probably want to see a little bit of inflation.
In Australia, we're talking, so it's the inflation it's within the RBA band, which is 2 to 3%. That's what we're talking about, inflation, which is high by international standards, but that's what we're looking at, 2 to 3%.
Yeah, I mean, I can't see it
moving
out of control.
Yeah, I think the first point I'd make is that inflation currently is actually not that low. Here in Australia, it's actually sitting between 2 and 3%, and as you rightly point out, we've actually got quite a high inflation target. I think the Aussie dollar today has been trading at 94 cents. I think there's a decent chance it trades down to 80 to 90 cents over the next 12 months, particularly if we get some stronger data out of the US interest rates increase. And we'll get almost a mechanical decline in the Aussie dollar. That again will flow through to inflation. So I'd be surprised if the Aussie dollar stays at its current level or doesn't decline further, if it declines further. I'd be very surprised if we didn't see higher inflation at the headline level, which is important for inflation-linked bonds in the next 12 months. Are we going to see an inflation breakout? Unlikely in the near term.
Yeah, and I think it's one of the things to think about in that inflation, in that it is in that 2 to 3, and by your assets it can produce greater than that 2 to 3. So that'll be your anchor, if you like, in the performance. That's why we're always talking about Sydney Airport's 4% plus inflation. If people get 6%, they should be quite comfortable over the medium term, because I think interest rates are low for quite a long time. So that's how we would structure it. But trying to pick the timing of it is the problem. So we think you just assume that if you can get 6% in the present environment, you're really only looking at upside. If the inflation comes in 2 years, 3 years, 4 years, buy the Sydney Airport 20s, the 30s, and you're protected over the long term, which is where you really need to start investing if you think about the fixed income piece. I'm curious. Right now, we're being driven a lot by the offshore market, probably more so than we have been for the last 9 months. When Europe calmed down, it all became the mining, it all became where our cash rates were. What's your thoughts on the offshore markets at the moment in terms of, Europe, China, China, all of it. It's China, Japan, Europe. What's your interpretation of how we're just being moved around now? That's where our troubles are?
Yeah, I mean, I think it's always a challenge, isn't it? The domestic market, whether it's equities or bonds, heavily influenced by the news you wake up to every morning. But as I think we gave the example earlier with, signs of stronger economic conditions in the US, who knows? Is that going to be good news for equity markets or bad in the short term? I think some of those relationships might well be breaking down, and it's a very volatile time. Volatility is quite high.
Incredible. And I want to talk to you a little bit later on about what assets people should be looking for with this sort of buffering around from the rest of the world, how you invest locally. But we have another caller, and the caller is Peter from Adelaide. Hello, Peter. You want to talk about a Westpac bond that's in US dollars? How can I help?
Yes, thanks for taking my question. I was looking at strategies to hedge against the falling Australian dollar, and one of the suggestions by my bank is to buy an AXA or CBA or Westpac bond in US dollars, which pays about, the AXA bond pays about 5.5%.
Yep.
And keep this for a while and then maybe hedge against the dollar later on. Convert it back to Australian dollars. But, what do you think of the strategy as far as any pitfalls, apart from the obvious that the currency might go the wrong way, but it's paying 5% or 5.5%, so I thought that probably a good way to offset it.
Okay, do you want to talk about that to start with?
Sure,
because I've got some thoughts on that one. I mean, I think, let's start with you, and I'll it's a great question, Peter, because it's really interesting how people are looking to hedge some of this foreign exchange, whether they have it or not. But let's talk about that.
Yeah, I mean, a few comments. The first is I'm not an FX expert. The second is that I'd ask you the question, do you actually really need to hedge Aussie dollar risk? Given you're an Aussie resident. The third point I'd make is if you're going to hedge Aussie dollar risk, understand the risks you're assuming and the exposures you're taking to the US economy. And ideally you'd like to diversify that hedge across a multiplicity of currencies. In fact, there's John Maynard Keynes, post-World War II, proposed a global currency called Bancor. And if you want global diversification, you really need exposure to a basket of currencies. So I'd suggest you think about that as well.
Yeah, I get it. We'll be talking about that after the break, because it is this idea that I need to hedge, but if your liabilities are local, that's what you need to hedge, if you know what I mean. But we have to leave it there. We'll have to go for a quick break, and we'll be straight back after this break. Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and joining me on the panel tonight is Christopher Joy, an AFR columnist plus the Yellow Brick Road director, and Simon Eagleton from Mercer. They're here to answer any of your questions, so please pick up the phone and call us at 1300 30 34 35 and the email yourmoney@skynews.com.au. I just wanted to talk about the GDP numbers. We had some big GDP numbers, or actually we didn't really have some big GDP numbers. What was your thoughts in terms of the overall economy? I mean, what's your sense, talking to all your clients, how does the economy seem to you in Sydney, in Australia?
Yeah, I mean, clearly we're in a period of pretty sluggish growth. But having said that, our advice to clients who are investing, and as you said, Mark, our clients are largely superannuation investors with long-term time horizons, and over that kind of time frame, we're actually favouring equity exposures, tilts towards growth assets. So,
but by that, what do you mean by that? Give me a sense of that balance. Is it that old-fashioned 70-30, 70% equities, or is that out of the 80s? Nothing is as black and white as that. It must be much more granular than that, surely. And I don't want to tell you how to do your job.
Yeah, no, sure. The growth asset exposures and the defensive asset exposures are highly diversified today, and that's not just what we advise our clients, but that's quite typical of the superannuation industry. So when I say growth assets, I mean everything that's considered sort of in the risky basket. Could include things like emerging market debt, for example, as well as equities. And I think if you are able, if you have the luxury of that sort of time horizon, like long-term, 10 years plus, then we see periods of equity market weakness right now as actually buying opportunities. I think domestically, in those sort of situations, you have regard to valuations, and I think we probably see the domestic equity market as certainly not cheap. So our favour is towards more global assets and unhedged assets with our view of the Aussie dollar.
We've had the US rally. Are you putting people into the US equities?
Yeah, I think the US market is one that's probably the other one that you wouldn't say is screamingly cheap, if not expensive, but globally diverse.
It's scary when we're looking at until they've unwound this QE. And until you work out what's going to happen with the employment. It's when the man at Mercer knocks on my door and says, "Go and buy US equities." I'm not sure I'm going to.
I'm talking about diversified global equities, including emerging market equities, and you're away, mate.
Okay, I love that. I'll be looking forward to that one. What about you in the GDP numbers in terms of the economy? Your sense of it?
Yeah, very very interesting. The GDP data. Basically, for the last 3 quarters, we've been growing 2.5%, slightly below the economy's long-term trend rate of about 3%. They're not nearly as bad. The RBA and Treasury's take on the data is they're not nearly as bad as people have been claiming. One of the great intellectual fallacies is we've got this so-called GNE recession, and basically people are saying, well,
what is a GME recession?
Gross national expenditure recession. But basically what's happened is the mining boom that everyone has focused on for years, the first phase of that was we built mines and we invested in these things to create the mines and the capacity. Now that's starting to taper and plateau, and it looks like it peaked possibly in Q4 last year, although the RBA actually thinks it may peak later this year. But here's the point. We built those mines for a reason, to produce things, and now we're having an export boom. And so exports are driving growth. And there's actually quite a good transition right now from investment to exports. Key point is that the Aussie economy is made up, about 17% of it is made up by investment, 22% by exports, and 53% by household spending. So exports are a very big proportion of the economy, and there's a good chance, I think, that the outlook will be a reasonable one, and we're not going to have fall into a hole.
It seems to me, and I could be completely wrong, but the problem is with the consumer. That the consumer is still GFC aware, they're still very conscious of the fact that they've got to repair their own balance sheet, so they're the ideal child that learned its lesson. But for the RBA, that's the problem. They don't spend the money that they've moved down the dial. I mean, is that what do you think?
Savings rates clearly are
home ownership is
quite
off the
high.
charts.
Yeah, but we have seen some glimmers of the return of the consumer in recent months.
We've missed them.
Oh, yes.
Auction clearance rates at 80% in Sydney last weekend and 70% in Melbourne last weekend.
Is that a price point though? Is that because they're paying up, or are they who's auction clearance? I understand you're very keen on that number, but it's a question of, are people looking to sell and therefore taking lower prices?
I think you're right. There's certainly an argument that vendors are hitting the market, but here's a counterfactual. I guess the point is that house prices in Australia have been growing modestly since May last year, and at the top end of the market, we're seeing really well-priced transactions. A property sold for $33 million and $52 million in Point Piper. I heard of an apartment as I was driving in here. Two apartments, yeah, $21 million bucks. Equities manager.
It's Bondi.
God love him.
It's beautiful.
So I think the housing market's in pretty good shape. The point I make on consumption is the RBA thinks consumption's been okay. It hasn't been spectacular, but the savings rate's been flat. So we aren't seeing, as you said, we're not seeing any leveraging up. We're not seeing any consumption binge, and I think the RBA would like to see stronger consumption growth to fill some of the gap left by that reduction in investment.
And in not getting it, do we see interest rates going lower? Is that what happens?
I don't think the RBA wants to cut immediately. I'm pretty confident of that. Having said that, there's obviously tremendous pressure on the RBA to provide as much relief as is possible. The RBA's view is borrowing rates, business and residential borrowing rates, are at their lowest levels in 40 years. Their currency's now off 10%. So back in May, when they cut rates, the Aussie dollar was at 102 US cents. They've got a lot more stimulus than they actually planned for. They want the Aussie dollar a bit lower. They think it should go lower. They still think it's slightly overvalued. But I think they're getting to the point now where they are slightly concerned about the long-term ramifications of basically the lowest interest rates in history.
So what you're saying is maybe not July, but maybe it could go August. They might cut 25 cents. Is that something that you at Mercer would think?
Share that view. I think there's another notch to go.
So I looked at some term deposit rates, and I talked to you before we came on. Suncorp at 440, 450 for 90 days, 455 for 90 days, and ING at 420, 430 roughly. I mean, they're massive rates for essentially, if you're $250,000, you can get a quasi-government guarantee, but you can get 90 days at some pretty fantastic rates compared to where the cash rates are. And of course, you can call FIIG and we can organise that for you if you'd like to do that. But they're still really big numbers. I mean, why is that, do you think? Is that a point of concern, or do you think this is just the option? It's the absolute rate as opposed to the compared to the cash rate. Do you think it's more that?
I think two things. I mean, firstly, 180 over the cash rate is a great rate. I mean, that Suncorp rate's a killer rate. You can also get on the ASX, the major banks have bonds paying 200 over, 190, 200 over. Slightly riskier, you'll get a bit of mark-to-market volatility, but we think they're also very, very attractive. But I think you'll see the smaller banks pay up. They'll pay over the odds for their TDs because, frankly, they can't raise money, especially cheaply, in the wholesale bond markets, and those TDs are an attractive source of funds.
Look, we're going to have a quick break, but before we do that, Simon, you're going to be on Speaker's Corner, so you're going to have 30 seconds to have the opportunity to say whatever you like. And you're on Speaker's Corner. I hope it's very interesting. We'll be starting now.
Okay, Mark. As I said before, I know a lot of your viewers have established self-managed super funds for lots of good reasons, but I think one of those reasons is around getting greater control on their investment programs. And I think that actually is symptomatic of a superannuation industry that's probably failed them. And what I'm very excited about, it's failed them because it's not flexible enough. And I'm very excited about, we're going to talk about in a moment, life cycle strategies that flex with members' investment requirements over their life cycle, start more aggressive, more equity oriented at young.
Welcome back to the Bonds and Equities edition of Your Money, Your Call. I'm Mark Todd from FIIG Securities. And joining me on the panel tonight is Christopher Joy, an AFR columnist, plus our Yellow Brick Road director, and Simon Eagleton from Mercer. If you have any questions about the share or bond market, please pick up the telephone and call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. And John has been very kind to send us an email. The email that John has sent is probably something for Simon. Do you agree with the rule that the percentage allocation of bonds to your portfolio should equal your age? Thanks, John. Simon, what's your thoughts on that one?
Look, what a terrific suggestion. Great email from John. I think there's something.
I should have 40% then.
No, I think there's something. I think there's something in there. And if your Speaker's Corner segment was a minute, I would have got some an exposition that explained it. But essentially, I think John's describing a situation where someone's asset allocation, and particularly, I guess, a retirement savings asset allocation, should change as their circumstances change. And I think in Australia, the younger savers, who probably don't even know they've got super or care about it, can afford to take a lot more risk and therefore have less bonds, maybe equivalent to their age. And older Australians, as they're approaching critical events like approaching retirement, should de-risk. Whether it's exactly the kind of as simple as your age,
that's right.
Questionable, but a great idea, a glide path is essentially.
And without wanting to be negative on our equity sales brothers, do you think they're saying that? Do you think that let's say that's, it's a bond show, so okay, we've got an agenda in terms of we think bonds are really good, but at the same time, if you think they're really good for a very good reason, it becomes self-fulfilling. It's the right thing. I feel that part of the problem with the equity world is that they never own bonds, they never want to promote bonds, they just don't do it, and they're talking to a 75-year-old man who said, this volatility, I wake up and I've lost 10% on CBA. I mean, that's just the wrong thing to have.
Yeah, can I take some of that? I think there is something, though, that someone who's just retired, the kinds of so-called target date solutions that we see in the UK and the US, a lot of them have got right down virtually no equities at the point of retirement. Right. But I think that's actually a mistake because, typical Australians today, arriving at 65, have got another 20 years to go, and so some growth actually. I
you don't want to have that at 65. I mean, what's some growth?
Let me make a few comments. I mean, I think I agree with Simon. The super industry has failed Australians, but on asset allocation, the biggest super fund in Australia, its weight to cash and bonds is 2% to cash, 9% to fixed income, and the rest is in Aussie equities, global equities, and then equity exposures to private equity or private companies, infrastructure and commercial property. So if the average Australian is 40 or 50 years of age, whatever the number is, does that imply then they should have 40 to 50% of their money, if John's right, and I agree with his principle like Simon, in defensive asset classes? And I think if you actually look at, not at self-managed super, but if you look at wholesale super fund portfolios, the asset allocations aren't remotely like those exposures I just discussed. So I personally think there's a lot of room to improve in that area.
I looked at a data point, and I might be wrong, but to your point, these industry funds I think have got on average something like 9%. And they're in fixed income, and that was quite surprising to me.
Australian Super has 2% in cash and 9% fixed income. Obviously, Mercer's not advising them, but
and we love them dearly because they're a very good client.
Can I give sort of not their side of the story, but something to think about? How much you have in super is actually a big issue here. If you think about a retiree, we're heavily reliant on the old age pension, and it's kind of like a bond, right? Yeah. That's a very big part of their sort of retirement investment program, is a risk-free, hopefully, bond. So maybe, the other assets could well afford to take some risk.
But they're not risk-free. They change. They change the circumstances. You need to extend before you can get it, and they need to play. You plan at 50 or 60 that you think you're going to get this pension, and all of a sudden that pension plays around. You've got to go and fill in all the different paperwork, and it's much more challenging than here's $300 a week or whatever it might be. I think that is moving away from the idea that shows like this are trying to say to people, you need to get up the curve, the intellectual curve, and take a little bit of control of your own life.
A really good example of that, and it's relevant for a bond show, and that is, if you think about the kinds of defensive assets you might want through a savings career, you start off maybe nominal bonds as being your fixed rate. Chris loves them.
Clearly.
Your fixed rate bonds, because they do provide the diversification against equities. But as you get older, you start to face things like price inflationary issues in retirement. That's a big issue. What about
the healthcare
healthcare? What about a different mix of bonds? More inflation-linked bonds, perhaps,
and floating rate bonds. I think that's actually a really profound point, and we've discussed this many times before. But the bond market isn't just about nominal fixed rate bonds. We also have a big floating rate market, and the beautiful thing about floating rate bonds is that basically the interest rate the bond pays moves up and down with the RBA cash rate. What does the RBA do with the cash rate? It targets inflation. The correlation between the RBA's cash rate and inflation over the last 20 years has been 73%. So I think you're 100% right. The bond market's a rich universe, and there's lots of opportunities to use it over your life cycle.
And speaking of life cycle, let's talk about some life cycle choices that you're offering at Mercer. I mean,
we are. We're about to come out with, and we've talked about this before, Mark, around the whole regulatory reform in the industry, the stronger super, and you'll see a lot of providers coming out with so-called My Super products. Right. And our My Super product at Mercer is going to be a life cycle strategy where the asset allocation automatically changes over people's lives.
How does it happen? How does that work?
It works. It's essentially we're talking about the option that is the option that the disengaged person, not your viewers, Mark, but the disengaged viewers who don't make an active choice. Can we come up with something better than the current industry offering, which is a static, never changing, highly growth oriented strategy?
That must be very complex to try and put together, though.
Yeah, under the hood there's a lot of stuff going on, but
how do you price it? How do you then say, okay, you need to give it, because part of the problem has been that no one wants to pay money for anything.
Yeah.
You know, how do you get that worked out?
Well, I think one of the things we try to do at Mercer is leverage or exploit the scale that we have with institutional size of assets to deliver, really low-priced solutions, and it's no more expensive than the typical offering in the market. In fact, if you change the asset allocation over time, so as someone gets older, they get more bonds, more diversity in their bond portfolio, that's when their account balance is higher. And I think there's lots of people who would experience a lower overall fee.
And less alpha in their business, and so they're not, and for the viewers at home, the alpha is churning, because when the broker rings up and said buy it again and sell it again, that's your alpha.
Just quickly, I'd say that
we're about to do Speaker's Corner, so be prepared.
Okay, but my point is that I think it's a great product, and if anyone's going to set asset allocation, you probably want Mercer to do it for you, because they do have a huge global research team that is expert in that, because asset allocation is extremely tough, and a lot of people get it wrong.
And you don't have to use the 30 seconds to say you're not sponsored by Mercer. That was a very nice comment you just made, but we'll have to leave it there. We'll go to a quick break, but before we do that, it's time for Speaker's Corner. And Chris, you're going to have 30 seconds to give us your view on whatever you like, whatever the soapbox tells you.
Sure. So positive message and negative message. The positive message would be the global economy is not just about the US, UK, Europe and Australia, or the so-called G7. 60% of global growth, 60 to 70% of global economic growth over the next 5 years will come from the developing world. Negative point is simply that when governments stop interfering with financial market prices and this money printing ceases, expect major changes and adjustments, and you need to prepare your portfolios for those shocks.
We talked about that up. Welcome back to the program. Our phone lines are open on 1300 30 34 35, and if you'd like to email, the email yourmoney@skynews.com.au for any questions on the bond or equity market. We've both been talking about portfolio construction. Let's talk it. Let's describe it as a 65-year-old man. How relevant? How does he go about getting the information on portfolio construction? Because he might say, "Oh, I heard in the show, I need 65% bonds." What does that mean? And he starts buying bonds everywhere, and he goes onto the stock exchange and he buys Crown, and he thinks that's a bond. How do we go about getting the information, getting it right for self-managed super funds, which is the largest segment of the growing investment market? How do we do it?
Well, I think one of the things is you go and get some advice. Just about anything that's a pretty good answer, right? Mm-hmm. Go and get some advice, and there's no doubt that this is such a sophisticated and complex world. The kind of securities that are out there, very difficult to understand. I reckon get some advice is the answer. Just to get back to an earlier point that I made, Mark, I do think the industry to some extent has failed. It'd be nice to think that 65-year-olds could put in place sensible things without having to get advice, and that means better designed investment products. I think we're starting to see the industry respond to that, but
the 65-year-old could really sort of dumb it down. He could buy Suncorp at 4.5. He could buy Telstra 20s at 5 or 4.5, whatever. He could probably go and buy a whole bunch of bonds that he's not really going to be worried. He'll buy some Telstra shares, some CBA, some Westpac, and he'll say, look, I'm done. I'm going to live off those dividends. He could make it simpler, I guess.
He could, but what do you do when the Suncorp bond matures in 90 days?
Sure, so he's going to have some cash pieces, so he might go to Rabo at 4.15, or he might go to ING. But he could play around in the really high up in the capital structure and not be as concerned about the investment choice. So he could say, I'm just going to invest in TDs and I'm going to get 4.5, whatever, and the stockbroker will say, well, I can get you 6, and okay, I'm going to take 4.5. Now I do believe there is an investment thesis around low interest rates. It's harder, it's 50% higher, but we can talk about that for weeks. Portfolio construction. Chris,
I agree completely with Simon. I mean, I think you've got to get good financial advice.
Stop doing that. Everything you've started was, I agree with Simon.
I think good financial advice is very, very hard to come by. Obviously, you can go and speak to Yellow Brick Road as well if you want an advisor. But I think portfolio construction, as Simon said, phenomenally complex subject. I do agree with a point you made, Mark, that one of the nice things about fixed income is you can play in different parts of a company's capital structure. So companies on the ASX, they fund themselves through debt and equity and things in between. So you can buy the direct equities, get the dividend yields, you can invest in the hybrids and get 280, 300 over the cash rate. You can play in the subordinated bonds and get 200 over the senior bonds, so about 100 over.
200, we're talking 2% over. So
that's right, 2% over the RBA cash rate. Or if you want as riskless an investment as you can possibly find, a bank deposit. But remember, a lot of people are still taking bank credit risk in bank deposits, particularly if they're investing through a pooled super fund.
Right. Let's talk about your product, Retire Right.
Yeah, sure.
Is that a new product that's come out?
Yeah, so Mark Boris and the Yellow Brick Road team launched a new super offering. It's called Retire Right. The idea behind it is to provide a very cost-effective solution. It's really meant to compete against industry funds. So I think the cost is about 0.75% per annum, or 75 basis points annually. They have 3 solutions: a defensive, balanced and growth portfolio, but they also give you the ability to invest in the top 200 ASX companies and in, I think, 23 different term deposit products. Oh, yeah. So it basically, in a sense, is like a de facto self-managed super fund, and it seems like a good offering.
And it's 75 basis points?
Yeah, per annum.
Has it been much?
Huge demand. Out? Yeah, it's out there, and I've seen the numbers. There's a tremendous customer interest. I think one of the...
Is that because, no disrespect to you because you've got a great profile, but is that because of Mr. Boris's profile? Is that what people follow? They follow the if Warren Buffett did the same thing, it'd be swamped. I mean, if I did the same thing, my mum would give some money, my dad wouldn't. But
Mark is really a strong believer in the small business sector and what he calls middle Australia and the mass market. He's not interested in creating a high net worth private bank, and he, I think, would potentially say that if you look at the offerings that are provided by the incumbent oligopoly of the major banks, they're vertically integrated. So they're providing you the bank deposits, they're putting you into their own super funds, which are investing in their own funds, which are provided by their own financial advisors, which are listed on their own platforms. And there's a lot. I think the issue there is there's a lot of bundling of costs and prices that are not transparently disclosed.
Yeah, that's right. Well, we had the gentleman that rang in and he said, my advisor's saying buy AXA. I'm not saying buy AXA in dollars or sterling or buying Westpac in US dollars or CBA in US dollars is necessarily a bad strategy, but it seems to me that and let's not say anything bad about the banks, but the advisor on the end of that line, wherever he works, I think they need to have this real Chairman Mao re-education program. And the chairman wants them to actually start thinking about the liabilities and the assets and matching them up. And I don't feel investors do that a lot. I don't think advisors do that a lot. You guys do, but is that the problem? Do you see that as a problem in the market? Stockbrokers saying just buy this?
Yeah, I think one of the challenges you've highlighted there is a classic principal agent problem of alignment of interest, and this is something that we address all the time in the work that we do around things. For example, performance-based fees.
Oh yeah.
So it might be a great idea, but if you've got some skin in the game as well, I might believe you.
Yeah, that's right. You've got to be connected. We have got another caller. We have Terry from Sydney. He's looking to invest $400,000 in some bonds, I believe. Terry, how are you?
Good, mate. Mate, just a simple question. I've only ever owned stocks. I'm 68 years of age, and the answer to that is that I'm finding this volatility. I'm getting very sick of it. I need a bit more security in my life, so I thought I'd take a percentage of my super and put it into assets such as bonds. And I was wondering how I'd go about it, firstly, and secondly, which way would be recommendable. Yeah.
Okay, great questions. Do you want to lead?
Yeah, sure. Just very quickly, bonds are just a loan to an institution. So a bank deposit is not really very different to a bond. You're lending money to the bank. It's actually, a bank deposit is an unsecured loan, whereas you can get secured loans. So three options. You can obviously go into cash and put your money into a deposit. Second option is you can now invest in a pretty large number of ASX-listed bonds, small sums, they're divisible, great exposure, senior bonds through to very, very risky hybrids. Or go to someone like FIIG, get some advice on what's available, and they also can provide you exposure to that spectrum of opportunities, including divisible or smaller lots of unlisted or over-the-counter bonds.
You know, the over-the-counter market is the bigger market. It's massive, Terry. So, you know, obviously we'd love it if you call FIIG, but there are other organisations. I can't remember who they are, but regardless, there's other. I think it's all about the idea of getting education. I think the premise is right that you say, I've got this amount of money and I'm looking for the return, and then doing the due diligence, whether it be on the fund manager, Capstream, Aberdeen, all the Schroders or whomever. Or you either do the education on the fund manager or you do the education on the assets. I prefer the education on the assets. That's nothing to do with negative on the fund manager. I just like the intellectual process where I'm starting to learn more, and then I think you just open up an account with a range of different people and allocate the cash.
I was just going to add one thing. I think Terry's on the right track, and it's good advice. One of the things I think we haven't talked about is diversification. I mean, it's the only free lunch in investment. Yeah. So something for Terry to be aware of is diversifying your assets.
So FIIG just came out this week or last week. There'll be some press releases on it, but we now do bonds in $10,000 denominations for a certain array of bonds. That's right. Wow. Yeah. That's so we've done all this work around the idea of solution-driven management. In other words, we've got bonds at these prices. The clients haven't got the funds to be able to meet the need. So they buy $50,000 worth of bonds and they might get one bond. We came to the idea, let's invest $50,000 and give them an array of bonds. And that opened up a whole broader spectrum to this fastest growing sector. The self-managed super fund sector really has about $900,000 per man, woman and child. So you had to find out how to create the right slice of their investment pool. Well, it made sense to try and do it in 10, so we've just done all this cost analysis, cut out all these costs and said, right, here's how we can do it on a platform, in theory, platform basis.
That's a great way to implement more diverse portfolios, right?
Yeah, that's right. Yeah, and you get all the different names. It's the Veros, it's all the traditional names. We would definitely promote some guys, some clients would have the linkers, just because of that concern about where interest rates are going. We will go to another break. We'll be right back after this, and hopefully we'll end up with lots of arguments. Do something. Welcome back to the show. It's the final segment for the night, so if you have any questions, you better be quick. 1300 30 34 35 and the email yourmoney@skynews.com.au. Chris, you've been writing in the paper actively about the government bonds and the government's debt levels. How do we compare to how does Australia compare to the rest of the world?
Well, I think the first point is that the Treasurer and generally I think the government's misled the community about Australia's finances. They claim our net debt ratio, that's the value of net debt divided by GDP, is only around 10 to 11%.
Yep.
But in doing so, they're excluding all state government debt, all local government debt, and all government-owned company debt, like the NBN Co and Australia Post and so on. So you add that back in.
Because they don't underwrite?
No,
Is that because they don't issue it, so therefore they say, we underwrite it by default, but is there a contractual...
Well, they're comparing us to all these other countries that don't have federated structures and consolidate all their government debt. So it's apples with oranges. Long story short, mate, once you include all that stuff in the numbers, they double. So it's more like 20 to 21%. But here's the real point. The point is that in December 2007, Australia had about $150 billion of government debt outstanding. That was the money that taxpayers owed, effectively institutions and the rest of the world. Within about 5 years, that's grown by $350 billion to by 350 billion. So our total debt outstanding today, or as of December last year, was 500 billion, and it's growing very, very quickly. And the problem is...
Why is it growing quickly?
Well, because we're running big budget deficits. So we're running budget deficits, and guess what? All the states are running budget deficits as well. So my concern is that the debt situation is significantly worse than the government's letting us to believe. The gross debt to GDP ratio is about 35%, and it's back at 1991, 92 levels, which is a bit of a worry. And the real concern is if we do have a bad shock, which is not my base case. So if we have a recession, we've already got the cash rate at 2.75%. So the RBA's already floored interest rates to the lowest level in history, and we're running big budget deficits, so we don't have much fuel in the tank.
But there's not much you can do about it in the environment. I mean, you can step in here and support me, I know you will. There's not much you can do about it in terms of the global economic situation. I mean, they're just... The deficits you're talking about in terms of the performance is driven by, the rest of the world at the same time.
That's just... Mark, sorry to interrupt, but that's just not right. The Treasury and the Parliamentary Budget Office have, and not to bore the viewers, but long story short, Wayne Swan, Kevin Rudd, Julia Gillard spent $67 billion of extra cash during the GFC they didn't need to spend.
I'm going to have to go, but Mr. Abbott's going to do a lot better, I'm sure. Goodbye. That's all we're going to have time for today. Chris will be back with his next thoughts on the infrastructure bonds. So thank you very much for Chris Joy, the AFR columnist and the Yellow Brick Road director, and of course Simon Ingleton from Mercer. And to you, all the viewers, for the calls and the emails next time. Until next time, I'm Mark Todd from FIIG. Have a great long weekend.
The information featured in this program is general in nature and therefore should not be relied